Sometimes there's a misunderstanding of what an identity is. Identities have their issues. They don't tell us anything about causality. They tell us nothing about how things interact. But they do have the merit that they're always true. But they're also always true at every minute, every quarter, every year. There's no leads or lags. So the saving investment identity is not saying that someone saved and say in a prior period and now they're making an investment. Those ideas that most of us have understood in the past. It's simply saying that they always equal each other because it's true by definition.
Welcome to InFi, the future of finance.
Hey everybody, welcome back to the InFi podcast. This is going to be an unusual one, but I think some of you are going to really enjoy this. Other ones, you might be scratching your heads. But in any event, what I'm doing with my guest, Charles DuBois, is explaining the accounting tautology of S equals I, which stands for savings equals investment. And I know that might sound obscure, but for those of you who are interested in the relationship between macroeconomics and the financial sector and trying to evaluate, for example, government and central bank policies and what impact may that have on the economy and your portfolio, this is something that it's important for you to at least understand the big picture on. All right. And what's really interesting here is that this is an area where there's a lot of confusion and a lot of talking past each other. And I'm still personally trying to get to the bottom of this. All right. So there's going to be an accompanying blog post at the Infineo website. If you go to the show notes page for, this episode, again, this is going to be episode 94 you're listening to right now, then you can find a link to it. But in any event, I have Charles DuBois on, and the backstory is just that he started emailing me at this point, I think more than 2 years ago, sort of challenging me slightly, but just sending me material, trying to say, Bob, when you're talking like to these MMT people, you're a little bit off here, or there's something you're missing. And it took time, but eventually I realized, okay, at the very least, this perspective that Charles is sending me and talking about is worth addressing head on, because I can't just keep saying, no, you guys are confused, that there's something here. All right. So that's what we're trying to get to the bottom of. And last sort of caveat I'll say is, because this is such a strange and obscure topic, I told Charles, let's not get too deep into it and start hashing out like where you and I disagree. Let's just sort of give the lay of the land to the listeners so they can understand the scope of this controversy. And then we defer to a future episode that I may have him back, where we're going to get more into the weeds and explain like where I'm coming from and where he's coming from. But here, I'm just trying to have him on to just summarize, again, this big picture and what does it mean to say savings equals investment necessarily. All right, so that may surprise you. If you're familiar with economic controversies, you may have thought that, that's something economists argue about, that maybe the market-friendly economists think that, don't worry, if people save a lot, then investment will respond, and maybe the Keynesians think it won't. And that's what I'm saying, that's the context I had going into this, but yet there is a school of thought that says, no, but if you just look at simple accounting relationships, then savings necessarily equals investment in every period. It's not even like in the long run or something. Okay. So that's what we're trying to get to the bottom of, and then see what is the relationship between those accounting tautologist claims versus the more empirical, theoretical, economic claims. Okay. Just a little bit on Charles's bio, in case you're wondering who the heck is this guy. So he's currently an advisor to Spring Valley Asset Management. From 2010 through 17, he was the director of research for NACV Van Ness Asset Management. In 2009, he retired as a global partner of Invesco, where he had been the director of tactical asset allocation. As far as his training, he's got a BS in mathematics from the State University of New York at Oneonta and an MBA in finance from New York University, and he is also a U.S. Army veteran. So without further ado, here is my conversation with Charles DuBois. Well, Charles, welcome to the InFi podcast.
Thank you, Bob. Great to be here. Glad you asked me on.
Sure thing. Yeah, I'm excited to do this. So I would have explained a little bit in the separately recorded introduction here, but what we're talking about, folks, is there is an accounting identity, S equals I, savings equals investment. And what's interesting is this intersects a lot with various schools of economic thought, particularly when they're arguing over recessions or, how do you get out of a recession, that sort of thing. And what is even more interesting is that prima facie, the way I learned of this dispute in terms of the saving equal investment is that typically a free market type economist says, oh, we like savings. That a healthy, productive, growing economy has a high savings rate. And don't worry if consumers cut back on going out to eat or going to the movies or buying a new car every 2 years, and instead they save more. That's not going to hurt employment, because as long as the financial sector is operating efficiently, their savings will get channeled through banks or other intermediaries, and will make more, interest rates will come down. It's the so-called loanable funds theory, and cause investment elsewhere, and resources just get reallocated. And so that's kind of where, and so normally you think a free market economist thinks that at least in the long run, savings tends to equal investment, and there's not going to be this glut of savings and depression. And so that's what's interesting. And I don't know if you know this, Charles, but when I was reading the general theory for this first time, early on, Keynes goes through it. And here I was expecting him to say, oh no, if people save too much, then that causes a problem. So I thought he was going to say that too much saving, there wouldn't be enough investment to absorb it or something. But no, he early on went through an exercise and proved that necessarily S equals I always, regardless of your theory about macroeconomics. So
Right.
that's the first inkling I ever got of this. And that shocked me when I read that. I think I was in grad school. I might have been undergrad. I can't remember. And so that's kind of what we're talking about. And then the last thing I'll say as a prelude, Charles, and I'll let you, explain your interest in this topic, is that this intersects obviously with the MMT camp and their doctrine that, hey, don't look at government debt as this burden on society. In fact, turn that frown upside down. The government debt is the only way that the private sector can have net financial savings, which, that's something that Stephanie Kelton's been beating the drum on. And so anyway, I kept encountering this thing. This last thing I'll say, folks, is so then Charles here started emailing me and, telling me that, no, Bob, or maybe you called me Dr. Murphy or something in the beginning, but this isn't a hill you want to die on here, that there is this legitimate sense in which savings always equals investment and net financial savings equals zero, all the things we're going to go through. So the function of what we're doing tonight, folks, is I'm having Charles here because he really is an expert. He's been sending me all sorts of literature on this and has very thoughtful critiques of some of the stuff I've written on this. So he really understands this topic. So before we dive in, Charles, and let you just start walking us through it, can you maybe explain how did you come to have such a command over this relatively obscure concept?
Well, I don't have the expertise you do, but yes, I guess it was around maybe 15 years ago. I sort of semi-retired at that point. I'm very busy these days and lots of stuff, but as you know, but I was just reading this piece by Jim Grant, of all people, and his letter, Grant's Observer, you may be familiar with. Yeah. And he said that profits equals investment plus deficits. And I scratched my head. I said, I never heard that. And I scratched my head. I actually wrote it down and on a piece of paper, and I never revisited it for 6 months. And I came back and looked a little about how deficits create profits, which are part of savings. And then a friend of mine sent me a book. He sent me a book, and it turned out to be Warren Mosler's The Seven Innocent Frauds of Economic Policy. And
I think it's the seven deadly innocent frauds.
Right.
Yeah.
And I said, well, this is interesting. Also, it tied in with some of the other stuff I've been reading. And I said, wow, this is really a different way of thinking about things, about saving. And so I investigated more. But my motivation, I guess, was in my past career, I never paid too much attention to economics other than how it related to the markets. And my only view was that economists are smart people, but they aren't very good. They aren't the best at forecasting, but that's fine. But I assume they understood basic macroeconomic relationships correctly. I assumed all that was well known. Everyone agreed about basic relationships. But then reading this stuff, I said, wait a minute, there's disagreement about basic relationships, or the idea that, to your point, that public deficits are private surplus. I had a friend of mine who was an economist who worked with the economists at one of the companies I worked with. And I said to him, what about the relationship that a public deficit is a private surplus? Does that make sense to you? And he thought about it, and he said, yes, but I never heard that said to me. And he was one who, his father was an economist, his uncle was an economist. He never heard it expressed that way. And so Anyway, so the motivation was then when I got into it, I realized that organizations like the CBO, the Congressional Budget Office, they run models on projecting the impact on deficits in the future. And they make an assumption that higher deficits crowd out, reduce savings, and thus crowd out investment. And they have specific assumptions. I think I mentioned that 35 cents of every dollar of an increased deficit reduces saving in their models. And so the world is relying on that assumption, which once we get into the discussion of saving, that assumption is false. And when we get into it, you'll see that the CBO, they're basically forgetting that, we can discuss it later, but they're forgetting that when money changes hands, it doesn't disappear. So my motivation was that, well, the world is being run based upon this false assumption buried deeply in all the documents. It's very nerdy and no one's even paying attention to it. But policy at the highest levels, for example, in Europe, the measures to maintain debt levels, to have limits on debt levels, if you go into the details of the documents, it's based importantly on the crowding out assumption. And why is debt bad in the first place? So that motivated me I said, well, this actually affects the world. So I said, well, that's a way for us older people, put some meaning into our lives. We can change the world. and I actually had the opportunity, at one point, because a friend of mine knew somebody, I spoke with several members of Congress. This was about over 12 years ago now. And so I've had some opportunities to have some influence in that direction. And I met with, it was the New Democrats, a group of them.
If you told them to run up bigger deficits, you did a good job. They listened to you.
Right. And interestingly, not to get into that, but it was interesting that the guy who set up the meeting, Representative Ron Kine of Wisconsin, he got it. He understood what I was saying. He actually he said it back to me better than I explained it. But he wasn't willing to go there. Anyway, that's we won't get into that here, but we'll get back to saving. And
well, can I so let me just say one thing. So I would have already said this in the pre-recorded introduction, but in case people skipped it, I just want to reiterate, folks, today, in this discussion right now, the purpose from my perspective is not to debate Charles here. And so if you're a listener and you really believe strongly in the crowding out element of government deficits, I urge you, don't have your guard up. Like there's definitely, I promise you, an accounting sense in which the stuff Charles is saying is correct. And then, he and I at the end of this can talk about what are the implications. Does that mean that, conservative economists are wrong about the crowding out, or are they using the terms slightly differently? Whatever. But let's make sure you get the sense in which this really is true. And for that, in the outline, we were sharing, Charles, I think the first thing you thought was important to establish is that this is an identity. This isn't a theory. And so do you maybe want to explain that distinction?
Yeah, I should mention the other part of the motivation was that, all of us are debating issues every day, all these things going on in the world, but they're not black and white, most of them. And I found it appealing, given my nature. I said, well, this is a 2 + 2 = 4 issue. Very clear. Mm-hmm. Maybe people still won't agree, but at least I feel comfortable arguing it.
Yeah, this isn't like abortion or something. This is pretty...
Right, that was the example I was going to use. Right, exactly. And so that made it appealing.
Okay, yeah, sorry. I thought you were going into the meat of it. I didn't realize you were still giving the motivation. Sorry about that. Right. So, okay, so this is why you realize this is important. This isn't just some theoretical curiosity. And so, as you said, it's sort of buttressing your point there. The interesting thing here is the perspective that you're coming from and where you're going to be arguing from in this conversation tonight. This isn't that you have some rival macroeconomic theory about what causes the business cycle or something, or you're making empirical assumptions about what fraction of household saving gets turned into loans to businesses or something. This has nothing to do with any of that. This isn't some long-run tendency. This is accounting identities. Like, you can prove it.
Yes, and there are economists who explain this better than I can, but it's not well known by the majority of economists, I would say. Understood.
Yeah, and also as we get this, let me say, folks, too, partly how Charles got me to realize this isn't just some MMT hobby horse or something, is he was sending me like textbooks and articles from people writing for was the IMF and stuff like that. That again, there is a branch of people who are trained like in financial economics. I think that's really what it is, Charles, in terms of the different groups that economists who specialize in financial economics, especially if they understand standard accounting. Because we may have said this over email, Charles, but I think most economists can't read a balance sheet, just period. Like they know what it is and they're not like mystified by it. But if you actually just said off the top of your head here, organize a balance sheet, here's some assets and liability, they might not know how to do it.
Right.
So I know for sure they would not know how to show a bank making loans, a fractional reserve bank. That would, unless they've done it before on the fly, they wouldn't be able to do it. So anyway, I don't want the listener to think by your sort of casual remarks that this is some obscure thing, like within a certain group. And that's partly what you did, Charles, and why I wanted to have you here is because it was you're emailing me all these different sources that convinced me that, okay, yeah, this isn't just some quirky thing that Stephanie Kelton and Warren Moser believe in. Like there is a school of thought here. Okay, so should we start with the net financial saving always equals zero? Is that the place to start?
Yeah, just an anecdote. I may have mentioned to you, but along those lines, I came across this paper written in the 1960s by the, can't recall his name offhand, but he was head of NYU Business School at the times that, anyway, he was prominent in developing flow of funds accounts, which were just starting in the 60s. And he made the point then that this, it all adds up to zero. So,
right.
So it was long before MMT or whatever.
Yeah, and I should clarify that's the thing, folks. It's not just that, it always happens to be interventionist, progressive, Democrat economist or something. Like it's, again, there's a standard view that, if you're doing the flow of fund, like these things all just kind of like in terms of international trade, that on planet Earth, the net trade balance is always zero, that one country's deficit's another country's surplus. Like people get that you can understand that identity regardless of your views about tariffs or mercantilism or whatever, right? So I think that's a good analogy.
These are not political statements. There's no, right. Yeah, exactly.
So with that context, then, do you want to explain this fundamental point that net financial saving always equals zero?
Yes, we'll start with some basic ideas that seem strange. They seem strange to me when I first came across them. But one is that net financial savings always equals zero. Financial saving is your income minus your spending. So a very simple concept. And why does it equal zero? Well, economists all agree that all spending equals all income. But they rarely make the leap that, well, if that's true, then saving is income minus spending. Most people would agree with that. So since they're equal, it must be zero. It's just an identity. And a second way of thinking about it is that every financial asset has a corresponding liability. So the net must equal zero. And third, I would point out that the government, the NEPA, the National Income and Product Accounts, they report financial saving for the four sectors of the economy each quarter. And guess what? It always adds up to zero. And the data supports the theory. So it takes a while to absorb that and think about it, but it's important. And we'll get to the implications in a second.
Can we maybe just dwell on that just a bit? So I want to stress, because again, I know there are people that they're recoiling, their defenses are up. They're like, wait a minute, there's got to be a trick. It's critical that the adjective financial saving, right? So it's not that, it's not saying saving overall is zero, because the point is we're arguing saving equals investment. So we know investment could be positive.
That most saving is actually real, which is not what we're talking about. It's saving in houses and machinery and equipment and so on.
And so if I could, Charles, because this would help me just to push the point so people are like, well, what the heck is financial? So financial saving, meaning like in terms of financial assets. So just take two quick examples, like bonds. So I think it's clear that, if you're a household, you have a certain income. If you consume less than your income, you save. And if you, accumulate corporate bonds, in some quarter or over the course of a year, your household, you have positive financial saving. Sure thing. That's not impossible. We're not saying that a household can't engage in positive financial saving. But then, of course, by you accumulating those financial assets, namely corporate bonds, well, then that corporation, the accounting flip side is their debt has gone up because now they owe your household that much more, and so the corporation has engaged in dis-saving. And so the two of you added together, clearly it nets to zero. So that's the set. And the thing, folks, just to give a little history that I resisted for a while is I thought, yeah, I get it with explicit debt, but with equity, isn't that a different story? Like, what if the household, instead of their income's 100,000, they only consume 90,000, so the 10,000 in saving, instead of them giving it to a corporation to buy bonds from the corporate, what if instead the corporation issues more stock? And then that's how the household. So I thought the household has saving, invested in corporate stock. And I thought that's not debt to the corporation, right? But the way they do it in this literature is they still do treat that as a liability of the corporation, even though it's treated like it's, liability and shareholder equity, but it's still on that side of the balance sheet. And it's not just a semantic word game because it avoids double counting. It's just, I'll wrap this up, Charles, but this is what made it click, folks, with me. Because because the idea is, if you try to add up all the assets in the economy and you're adding up the households and you say, oh, they own a bunch of shares of Acme Corporation. If you want to count that, okay, you can do that. But then if you say the Acme Corporation owns a bunch of, coal mines and they own factories and they own forklifts inside, you listed all these real assets that the Acme Corporation is the legal owner of. Okay, but then that would be double counting if you just added those two things, because the households, their stock is largely reflecting the net assets. So the way you avoid that double counting is, okay, if you're going to count the real assets that Acme owns as part of total assets in the economy, then the financial shares held by the stock held by the households is the liability of the corporation. And so you still got to do the, otherwise you're counting those things twice. So anyway, once I did it there, I realized, this isn't some trick. This isn't like designed to justify Keynesianism or MMT. Like, this is the way to make the books balance.
Yes, or an easy way to put that is, if you own, say, shares of Disney, you own part of ESPN, the theme parks, real assets. You don't own their financial. They may have some financial assets, but that's a minor part of what they own, and those assets have offsetting liabilities.
Okay, so again, folks, the claim is not that aggregate saving is necessarily zero. The claim is that any group, you draw a circle around it and consider them as a whole, on net financial saving is always zero, because if any individual component engages in positive saving during a particular time period, in terms of the flow, that their consumption is less than their income, that there must be some other entity or group of entities in the same system that has engaged in counterbalancing dis-saving, right?
Yes, it's all very simple. If I give Bob $10, I have $10 less saving. He has $10 more saving. That's all.
Okay.
It adds up to zero, right?
Okay, and then again, just to reiterate the way you were trying to justify that, besides what we just said there, is that you say all spending equals all income. So people just think about that. Anytime you're getting an income, that corresponds to some other entity that is spending. Right? That's got to be the case. How can you have income flowing incoming, without it being outgoing to somebody else? And then if financial saving is income minus spending, then therefore it must be zero, is the way you put it.
The point was, economists all agree that all spending equals all income, but you don't hear the leap to making that next conclusion.
Okay. So we've established that, and people can say, okay, yeah, I'm with you so far. So now where do we go with that?
I think it'd probably be best to go to the saving equals investment identity, which which is what we're saying is misunderstood by the majority of economists. But if you think of that identity as you think of saving as consisting of financial saving, as we just discussed, plus non-financial saving, which is saving in real tangible assets, which is what total saving is, then you have financial saving plus non-financial saving equals investment. But we just concluded that financial saving adds up to zero overall. So that drops out. So you're left with non-financial saving equals investment. And the point of this identity is that, or the point that I'm trying to make is that the identity is misunderstood because it's not understood that the saving in the saving investment idea is simply the result of the investment and represents the real assets the real saving created by the investment. So it has nothing to do with people living below their means or saving, people saving money or other activities. That's not what the saving is. An identity. One thing we should mention is sometimes there's a misunderstanding of what an identity is. Identities have their issues. They don't tell us anything about causality. They tell us nothing about how things interact. But they do have the merit that they're always true. But they're also always true at every minute, every quarter, every year. There's no leads or lags. So the saving investment identity is not saying that someone saved and say in a prior period and now they're making an investment. Those ideas that most of us have understood in the past. It's simply saying that they always equal each other because it's true by definition. In other words, when a company buys a machine, they've made an investment, and if they buy the machine for $1,000, investment in our national accounting goes up by $1,000. The saving also goes up by $1,000. And that's all it's saying. And in one way, when it got me thinking about it was, well, if financial saving is zero, then the saving investment identity is not saying anything about financial saving. It's saying something different. Does that make some sense?
Yeah, let me see if I can repeat, distill down what you said, and obviously correct me if I'm getting it wrong. So again, coming from the economists arguing over business cycle primarily, like what causes recessions, and then particularly what should the central bank and or the government do to help things, if anything, that, there's often a dispute about the so-called paradox of saving or paradox of thrift, and the Keynesian interventionists, let alone the MMTers, will often say like, oh yeah, if people are clam up and they're afraid to spend, consumers are trying to get ahead, that there's a shock or something and people are trying to bolster their balance sheet, that causes this downward spiral. And then the defenders of the free market will often say, oh, no, like, once people just catch their breath and as long as government doesn't intervene, interest rates will fall, prices will fall, people will start spending again, and businesses will begin lending to credit-worthy borrowers, and then the people argue, well, gee, why would the business expand if its revenues fell? And they say, oh, well, because they're making a fork. Okay, but your point is, when you're thinking of it like that, and does saving lead to subsequent investment, perhaps with a lag? Clearly, what people have in mind is financial saving, that they have an income measured in money, they spend on consumption measured in money, and that gap is saving. And then the idea is, and how do you want to deploy it? Is it if you're a hoard, do you just hoard cash? Is that a problem? And economists have different views. And a lot of them would say, yeah, but if you lend it to a bank and then the bank lends it out to a factory, to a business, and they use it to hire men to build a factory, that's what's going on, right? So the restaurant lays off workers, but they get absorbed over here because of the investment spending. And so I take it your point is to say, whatever you think of those claims empirically, that has nothing to do with what you're talking about when you say there's an accounting identity that S equals I necessarily for any time period. Because again, it's just you're confusing things, that if you're talking about financial, it can't be that in general, every unit in the economy consumes less than its income measured in money, like financially.
Right.
Because if you just think of it, folks, like and this kind of ties into the paradox of thrift, that if all the households are trying to live below their means by cutting spending, well, again, when one household cuts its spending, that necessarily cuts somebody else's income. So it can't be that every unit at the same time in the same period can reduce its consumption spending and hence save more financially.
Right.
That's impossible.
A key point, right? So really what Bob is saying, if someone reduces their spending, what this identity is saying that it reduces somebody else's income and their saving goes down by an equal amount, and all that still adds up to zero. So that's correct. And
I don't know if this helps or if this is muddying the waters, but even just now as we're saying that, I'm trying to motivate for people just to show this isn't an economic claim. This is, that has to do with a school of thought or what's your theory of how the world works. This is just really accounting.
We can debate your example with the restaurant and so on, but the point is that the saving investment identity is not saying that. And
what I was going to say, Charles, I don't know if this helped, but for a given stock of cash, like again, this isn't like literally the exact same thing, but I think it's analogous. If you just have a certain picture, just a number of dollar bills, or tens and 20s or whatever, in the economy, and the point is it can't be that every household decides, you know what, I'm going to bulk up on my cash balances this month. I'm going to spend a little bit less than I normally do and just keep, add $100 to my wallet and carry that forward in the next period because I'm uncertain about it. It can't be that every single household adds to its cash balances unless, somebody's printing more money. But you see, that's kind of the intuition here of showing in terms of the accounting, it just doesn't work. If one entity is living below its financial means, then somebody else has to be living above it in the sense that we're using these terms.
Exactly. And so that's a very, to me, profound idea that the saving investment identity, which is everyone knows, is typically misinterpreted correctly. It's simply saying that, well, to use another identity that economists use, everyone agrees that saving equals income minus consumption. And whether you're an Austrian or Keynesian, or they all agree that that's the identity. But since we know spending equals income, you can also say that saving equals spending minus consumption, which sounds a little strange when you first say it. Saving equals spending minus consumption. But that's also an identity since income equals spending. And since leaving out the government or external just to keep it simple, but we can spend on investment or consumption. So if you follow that logic through further, it says saving equals spending on investment plus spending on consumption minus consumption. And you end up with saving equals spending on investment. Basically saying what I was saying about what the identity means, that we only save as a society through spending on investments, that getting to the big picture, we are wealthier than our previous generations, not because we have more money, it's because we have better healthcare, we have better transportation, music, and on, means of communication, and on, which is a result of investment, a growth in real wealth, which is what drives prosperity. And I think all economists agree on that as well.
Yes. So let's just elaborate on that because, again, critical stuff here that, we were beating perhaps a dead horse a minute ago there, just driving home the point that financial saving in the aggregate necessarily equals zero. And that's not some empirical claim. That's just when you think about the definition, the way we're using the terms, it's got to be the case. But then you say, okay, but so then doesn't that mean saving equals zero? And no, because when we say saving, we mean generally, right? So financial saving necessarily equals zero in the aggregate, but saving overall could be positive even in the aggregate. And that's because saving, broadly defined, is financial saving and non-financial saving, or you call real saving.
Yeah, in fact, I've discovered very few people realize that even on a personal saving that's reported by the government, it includes the value of residential housing. And probably when you hear the saving reported, most people aren't thinking in those terms. And that's, typically a fairly large number.
Right.
And there were periods 25 years ago when financial saving was zero for the household sector. The saving was still reported as positive because housing was booming. And that is, I tried to understand it, and I only was able to understand that because, I delved into the details, or I was thinking about just where is the residential housing showing up? And hey, that's a separate discussion. We don't have time for that. But that validates the point that it's real saving. It's included in saving.
Okay, let me try to motivate now for people to understand. Like, again, it's this weird jujitsu where they originally think that, I could see how everybody in the aggregate could save, if everybody just cuts back on their spending and, builds up their checking account and their shares of corporate stock and some of their treasuries and blah, blah, blah. Or unless they try corporate bonds, because we want to keep things private sector right now. That why couldn't everyone just do that? Everyone's paying down their credit card debt. And again, the issue is, well, then because the owners of the credit card company would see dis-saving, right? If people are paying down their credit cards, the credit card companies, their assets are going down. That's dis-saving, right? So once we beat people over the head to get them to realize, in the aggregate, you can't do it. Like it's sort of, whack-a-mole, one person, you get them to save more than the dis-saving pops up somewhere else. But then we're saying, no, but in general, they can engage in saving and investment. And they might say, well, how? And so tell me if this example works for you, Charles, just to kind of give an example, just so they see what the heck we're saying, what the distinction is. So I'm a household, my income's $100,000. Let's say I want to save $10,000. right? I want to bolster my assets by 10,000. One way of doing it is, so I consume 90, and then I take the 10,000 I freed up, I could go buy corporate bonds.
Yeah.
So clearly my household has saved $10,000. My financial assets went up by 10,000, but as we've talked about to death at this point, in the system as a whole, that's not net saving because the corporation. But what if instead I take the 10,000 and I hire a bunch of guys to build a gazebo in my backyard that has a market value of $10,000 when the dust settles? And so you can see how there I live below my means. Assuming we treat the gazebo as an investment, not just as my consumption. I have a real physical asset now to show for it at the end of the period, and you can see how the existence of that gazebo doesn't correspond to somebody's liability, and in fact, those guys earned an income. The $10,000 was an income to someone else.
Yes, I was going to use the example makes it very quick. Is if someone decides not to go on vacation, but instead buys a much needed new refrigerator and stove, they've saved, but they've saved in real assets, and there's no offsetting liability.
Yep. Okay. So you agree that that's the critical point, that when you save and then spend on investment on real physical assets,
that's saving.
The reason that is because it's not thereby incurring somebody else's liability the way when you buy financial assets you necessarily are.
So the saving and the saving investment identity is what we're just talking about.
Okay.
The real asset.
Okay, so to avoid confusion then, and this is something I remember now, Charles, early on when you and I were going back and forth over email, I'm trying to figure out what the heck we were talking about. What was tripping me up by, why I was resisting your worldview was to say, isn't it investment? Like, to me, it seemed like an arbitrary distinction. If I, I have an income of 100,000, I consume 90, and then I have 10,000, and whether I use it to buy corporate bonds or to hire some guys to build a gazebo, or if I pay the refrigerator company for a new fridge, isn't that all investment? So why, you know what I mean? So when we say saving equals investment, aren't we really just saying non-financial saving equals non-financial investment? Or you get what I'm saying? Like
yeah.
Are you just reserving the term investment to refer to spending money on physical things, not buying shares of corporate stock?
Yes, because when you buy shares of corporate stock, you're shifting your financials. When you buy the stock, you're handing over, the $1,000 to buy the stock, but someone else is selling it to you. So there's no change in financial assets in that sense. And you now own a claim typically on real assets in terms of the stock. So I think of buying a stock is it's just changing the composition of your portfolio, but it's not changing the world's portfolio because someone sold you that stock, if I'm thinking correctly.
Okay. I guess what I'm getting at is, I think it's analogous to how we treat the saving, that it's correct to say the household that spends $10,000 buying corporate stock, you could say they invested in the Acme Corporation, but would we say there's a sense in which Acme disinvested?
Well,
and so total investment is still zero in the system?
Well, when they invested in the Acme Corporate, I'm saying that's not part of the investment in the saving investment identity. That's just changing the nature of your assets. You're buying, in that case, a stock where they've already made the investment. The machines that say Acme Corporation owns. There's no new investment being made when you buy a stock. So there's no new saving in the economy, if that makes sense.
Oh yeah. I mean, it's kind of a quibble. I'm just trying to isolate the way the nomenclature. If the way they would handle it is to say it's still investment spending by the household when they quote invest in a company, right? Because we use that language where you say, "Oh yeah, I invested in Google or I invested in Apple when it was early, so I made a bunch of money." That we use that term, but because that spending doesn't show when we say S equals I, that's not included in the I. But I'm saying, is that because it zeroes out that the household's gross investment is counterbalanced by the business, or do we just not even say that was even an investment? Though, like,
I would say that
investment does that mean
not what economists mean when they mean investment?
Okay,
it's used in everyday terms, but it's not the investment that the investment
Right. And that's consistent with, so thank you. See, so that was partly, like I said, Charles, what was tripping me up originally is because I could tell you were using investment to refer narrowly to investing in physical assets that will, generate an income down the road, I guess is the way you would technically define it, which is consistent like with the GDP, the national income accounts, right? When they say GDP equals C plus I plus G plus net exports, that investment spending, that doesn't mean investing in corporate stock. They mean like,
Exactly.
buying more drill presses or fixing the insulation in your building or something. That's what investment means in that context. So
yes, exactly.
they don't mean financial investment, or they don't mean spending on financial assets, put it that way.
Right.
Okay, so big picture, even though we've stressed with this framework that the summation of all financial saving is necessarily zero in a closed system, that doesn't mean in that same closed system that saving has to be zero. People can save in the aggregate. Oh, what's that?
Of course. I mean, one question people would ask is, well, we have $150 trillion of wealth. So what are you talking about? We've saved so much. And we could go through that if we had time, that what that 150 trillion consists of, which is consistent with the financial saving equals zero, if you'd like. But very quickly, the 150 trillion, 60 trillion is housing, which is a real asset, 60, 70 trillion, and 40 or 50 of it is corporate stock, which is a claim on a real asset, and the rest is government bonds, the 30 trillion we hear about every day. And that's the asset of the private sector, but it's obviously a liability of the government sector, so it still adds up to zero. So the point is that our wealth is still consistent with financial saving equals zero.
Okay, so I think and folks, I will have written a blog post dovetailing with this discussion in order to spell some of this stuff out in case you're getting lost in the details. But I think the flow of what we said, the spirit, I think Charles come through. So now maybe we'll get into some of the implications. So here's where I may not continue on this journey with you, and I may disagree, but I think we've agreed, like I said, the important point is to establish up till now the sense in which, the way the terms are defined, and that this is not some arbitrary, obscure thing. This is very standard within certain circles in terms of how you do the accounting on this stuff and how the books all balance and there's flows of funds and whatever. And so now it does, I don't know, should we get into the MMT stuff? Is that a good place to start with the...
Well, I think in terms of talking about implications, we could start that, because one of the implications, if financial saving equals zero, then it follows that a public sector deficit must equal a private sector surplus, since they add up to zero. And that's sort of a basic MMT proposition. But I think the point is that it's a basic relationship, whether you ever heard of MMT or not.
Right. Okay. So in case this is new to some people, like people who follow my work closely will know that this is something that I've been grappling with for a long time. But for somebody who's never heard that before, I'll say it and then I'll let you elaborate. So Stephanie Kelton, folks, who is one of the leading MMT gurus now, she is a very dynamic public speaker and she's very glib. And one of the things she does is she says, she tells a story where she was in a group with a bunch of policymakers and, some economists and things like that, like government officials and whatnot. And she said, right now, the so-called public debt is just some big number. And she said, if you could just snap your fingers and get rid of that, would you do it? Or how many would do that? And she's polling the room and just about everybody raises their hand, right? Because they've been taught the government debt is a burden and blah, blah, blah. If we could just get rid of it, sure. And then she says, okay, right now, corporate pension funds and this and that and household blah, blah, blah own this much in treasury securities. If you could snap your fingers and have all of those treasury securities disappear from all their balance sheets and, from pension funds and whatnot, would you do that? And of course, nobody raised their hand because they were flabbergasted. And her point was, those are the same thing. And so, so driving home the point that the government's debt corresponds, if there's an outstanding treasury securities with the face value of whatever, $35 trillion or something, yes, that's how much Uncle Sam is in the red. But then that corresponds to there's a bunch of people in the private sector who own those as assets. And so it's black ink to them.
Right. So she succinctly puts it, the government's red ink is our black ink, which is another way of saying financial saving equals zero.
Yeah. So again, Charles, am I taking that you agree with that, and you think that, yeah, like for people who resist the MMT policies, the way to bail them is not to die on that hill. That really is just basic accounting.
Right.
Yeah.
MMT has its issues. I mean, one of the issues is they make it sound like we can't save unless the government runs a deficit, as you've just heard from the discussion. Most of our saving is in real assets, and that's something they're guilty of when people hear that.
Okay, so yeah, maybe just take a moment so that the folks at home who are getting shell shocked here, like, wait a minute, are you telling me Stephanie Kelton's right? That, yeah, my beef with her and that stuff is to concede that, yes, once you understand what the terms mean and the definitions were used, okay, that's true, but she's making it sound as if, it's a good thing the government's running big deficits because otherwise the private sector wouldn't be able to accumulate wealth. And that, like the country's standard of living couldn't go up over time unless it corresponded to an ever-rising government debt. And that doesn't follow from the accounting because, as Charles, you were saying, that you can still have positive saving and investment. It's just, it wouldn't be because every household's piling up corporate bonds, but because, factories are being built and more farmland's being brought under cultivation and people are learning better skills and stuff like that. More brain surgeons are being trained. And so that the real wealth of the economy is increasing over time with or without big government deficits.
I mean, to be fair, I think she would mostly agree with that, but I just think it's poor communication from the MMT people, because if they've said that the government's deficit creates only financial saving, if they use that word financial and emphasized and explained it, more people would listen to them perhaps, or it would be improve their communication. Because that's what they mean, but it's not what it sounds like.
Right. Yep. I agree. Okay. So I'm just looking at these notes that you jotted down before. You said not reliant on foreign buying. Do you want to explain what you mean by that?
Yeah. Most of us understand or feel that the national debt, for example, is owned in part by foreigners, and therefore we rely upon them to help fund our deficit. But if you think about financial saving equals zero, let's say that the trade deficit collapsed and foreigners had fewer dollars to buy our debt, that would be true. However, if foreign saving fell by $100 billion, to use that example, that there'd be $100 billion more domestically in saving, because it still all adds up to zero. In plain English, we'd be buying more things domestically than abroad, and so the dollars would be staying here instead of being in the hands of foreigners. So there'll still be the same support for the government bond market. So it addresses that concern that we often seen expressed, that we're relying upon foreigners to support the debt market.
Okay. And then, so I see that. And then this one, I'm still not sure if I agree with you or not on this. Because in other words, I still do think there's something to the so-called crowding out theory. But again, just so people understand where you're coming from, can you explain? I think I know at this point what your answer is going to be, but I'll let you do it. That somebody said, when the government, if they run a big deficit, maybe they're going to spend it on something really important like military defense or whatever, school teachers. But there's a downside because that crowds out, now that those loanable funds aren't there for private sector borrowers, because the government crowds that out. And so you better be careful, not just willy-nilly engage in government budget deficits. Make sure it's for really good things, because now we're missing out on all the private sector investment spending that could have occurred with that money. And so you have a problem with that.
Yes, that's a very important assumption, because as we said earlier, that's an assumption by the CBO and other influential modelers of the economy, like the Penn-Morton budget model, which has influence in Congress and so on. And they make an assumption that government deficits reduce financial saving and therefore reduce investment. And they understand the details, but their explanation is where they go wrong specifically is the CBO, for example, says when the government runs a deficit of, say, $1,000 and they spend it to the recipient receives $1,000, and the CBO explains that the recipient typically will spend 70% of those $1,000 that they receive. So when the government sold the bonds for $1,000, it reduced bank deposits by $1,000. This is a CBO talking. And the recipient of that spending only saved $300 because they spent the other $700. So overall, saving has declined. Saving available for investment has declined by $700. Again, the person buying the bonds saw their bank deposits decline by $1,000. The recipient of that spending only saved $300. But the step they're missing is that $700 they spent goes somewhere else, typically to a business, and increases business saving by $700, which is part of, this gets into a different discussion, but the Kalecki profit equation, which you've heard of. But it turns out that the $700 that they spent into Home Depot or whatever becomes saving for the business sector when you work it all through. So it still all adds up to zero. So there's no reduction in overall saving for the private sector. The $1,000 that was taken from the person buying the bond, in this example, the person receiving the $1,000 payment saved $700, and the business sector saved $300. I'm sorry, the business sector saved $700. So it's still zero, and there's no crowding out. And that's a little different than the loanable funds idea, but I'm addressing the way the CBOE explains their logic. I'm saying that they've forgotten that there's two sides to every transaction, and that money doesn't disappear, it just changes hands. And that is critical to the whole crowding out argument. So the point it's another way of savings equals zero. In other words, if the government just saved by 1,000, the private sector, in that example, the private sector somehow had to increase their saving by 1,000. And it turns out in that example that it was $300 in the household sector, let's say, and $700 in the business sector. So I guess what I'm saying in brief terms is that crowding out is not consistent with financial saving equals zero. In other words, crowding out is saying that that financial saving of the private sector goes down because of the government's deficit. But in accounting terms, a government deficit must mean an increase, private sector saving, which turns out to be the government bond, but everything else adds up to zero, and there's no reduction in financial saving. Now, you should add that crowding out, the government spending can obviously crowd out the private sector on a real basis, we're just talking about financial crowding out.
Right.
Like the CBO. I mean, if the economy is operating at full capacity and the government spends more money on infrastructure and everyone is fully employed, that just causes inflation and problems. And that would be real crowding out. But we're talking strictly about financial crowding out. So that's the argument.
So thank you for that. And I think, it's just as you were talking, I was thinking it through, not that you would necessarily endorse what I'm going to say on this, but I think when I write the post up that's going to accompany this episode, Charles, folks that will already exist by the time you're hearing this, but it doesn't exist right now as I'm talking about Charles. I think that's what I'm going to make the case for, that economists are kind of flipping back and forth a little bit loosey-goosey, but we actually have in mind real resources. And that what we mean is that, if the government borrows money and spends it to whatever, build a bridge somewhere, that the resource, the concrete and the man hours and so forth and the lumber that went into that is not available to go somewhere else. And I don't care what you do with $10 bills and stuff, that doesn't change that that primitive fact. But you're right, the way the loanable, for people who don't know, the loanable funds model says, it's just like there's supply and demand curves for apples, and the higher the price of apples, the supply curve slopes upward and producers are going to sell more apples, and there's a downward sloping demand curve, and the higher the price, consumers want to buy fewer apples, and equilibrium occurs where the two cross, and that's the magic point. They say the same thing with loanable funds, that there's an upward sloping supply curve of savings, and there's a downward sloping demand curve for investment, and the equilibrium interest rate is where those two cross. So if the government comes in to run a deficit, that shifts the demand curve to the right, that pushes up the interest rate. So that does pull forth actually a higher quantity of saving from the community, but the government ends up siphoning off more than the increase in the savings. So on net, there's less of the public's saved funds available to the private sector. That's the argument. That's what crowding out means. But I think what you're saying, so last thing
I'm
I'll
saying
make
there's
sure.
no reduction in loanable funds.
Right, is this right, Chard, that you're saying that talking like that gives the implication that the public on its own, if the government doesn't get involved, has some total aggregate amount of surplus financial savings. Like, oh yeah, we've all, tightened our belts and we've all passing the hat around in church or something. And we've all collectively saved this amount. And now what do we got? Which businesses we're going to auction it off to the businesses who want to borrow it to go do important things with and spend. And you're saying, no, when you realize that financial saving in the aggregate has to equal zero, you're starting at the zero level. So it's not like there's this positive amount that the government is siphoning away. It's zero. And in fact, if the government runs a deficit, then not only does that not reduce the amount of aggregate private sector saving, it makes it possible in the first place when you're doing it in terms of financial savings.
Yes.
Okay.
Yes.
All right. So again, my task, Charles, is to see if I can reconcile those two, because I definitely see what you're saying, but I still understand like why a Greg Mankiw or, a Murray Rothbard or a Bob Murphy, for that example, I've talked like that, I'm sure, without maybe necessarily drawing a loanable funds diagram, but I certainly have talked like that verbally. I still think there's something there, but yeah, it does look like superficially those two views contradict each other, and so something screwy is going on.
Yeah, I mean the MMT people, of course, use a different argument. Which is why I'm making this contribution. They don't make the argument that I just made. They make the argument that, as you know, that the banking system is not reserve constrained, and therefore there's no limit to loanable funds. But I'm making the point in the terms of the way the CBO and the Penn Morton budget model actually explain why the crowding out is in their model. They're not using a loanable funds theory. So that's significant in that they're not using a loanable funds theory to make the crowding out point. So I'm explaining it in their terms.
Okay, well, I'm seeing we're hitting about the hour mark here. Is there any final point you want to make on this?
Well, I think it's interesting just from an everyday standpoint. It makes it's kind of funny. I never heard anyone make this point, is that once you get this idea of financial saving equals zero, my joke is that now I know why nobody has any money.
Right.
If you think about what we do on a day-to-day basis, we pay a bill, so our saving goes down, and the electric company or whatever, their saving goes up, and we pay this person and their saving goes up, our saving goes down. So we're just spending money back and forth to each other, and this all adds up to zero. So it's no wonder no one has any money, and on a net basis. But it has a real world implication in that I make the point that if you look at the financial saving of the household sector, if you actually look at the actual numbers, it runs recently around $800 billion financial saving. But if you look at the dividends and interest, as you know, interest on the debt these days is a very high number also. And that's income for the private sector. And dividends are run on the order of a couple $1 trillion. And so if you think about it, dividends and interest are held by people receiving dividends and interest are not people who are typically using that for spending money. And the people receiving dividends and interest are not in the middle class. It's wealthy, rich people and pension funds and so on that are holding those types of assets. So if you think about the remainder of the rest of us, that would say the rest of us, our financial saving must be less than zero. So if you start with $800 billion and subtract some part of the dividends and interest that are going to the upper part of the income stream. So if you think about it, so the point is that, which I found compelling, is that therefore, in the aggregate, most of us have to struggle. Because we can't, getting back to your earlier point, we can't all live below our means and save. So if financial saving is zero, and an important part of it is being saved in dividends and interest, which are held by the top 1% or 10% primarily, that the rest of the people, it has that up to zero or less than zero. So I find it interesting to make the point that there's, in a sense, that people that we must, in the aggregate, must struggle financially, which is, to me, an interesting point because I've never heard it made.
Yes. So it is intriguing. And that is, again, another thing that I will try to tackle to consider that, because there is a certain, I don't know what, like you want to go read existentialist or something if you think about it too much. And so that's another issue, folks, I'll consider. And Charles, as we said, probably after you and I go into our corners and huddle and consider this stuff more, maybe I'll have you back and we'll do a part 2 of this. But I think this is a good chunk for people to digest and give them an introduction to this strange idea that savings equals investment and net financial saving in the overall system necessarily equals zero. That's when you ponder that, it has some interesting implications. So, folks, my guest has been Charles DuBois. Charles, thanks so much for your time and insights.
Thank you, Bob, so much for having me. I really appreciate it. It's really wonderful.
Yeah, I really enjoyed this. Thank you. And thanks, folks, for tuning in. We'll see you next time.
Thank you.